Transformation happening right now in financial services. It's all driven by technology.
It really is a profound shift.
And we want to explore how these digital-only banks, neobanks, are completely changing what customers expect and, importantly, how they're boosting financial inclusion. We'll be focusing quite a bit on South Africa today.
A fascinating market for this.
Absolutely. And just quickly, before we dive in, if you're listening for your professional development requirements, stick with us. Completing the short quiz after this analysis gets you that required CPD certificate.
Okay, so first things first, what is a neobank? Essentially, they're tech companies that do banking.
Yeah.
Purely digital.
No branches.
None. No legacy IT systems weighing them down either. They operate entirely online, often just through an app. Think Revolut, Monzo, Chime, globally. They're showing banking can be, well, simple, transparent too.
And in South Africa, this isn't just a ripple, it's a wave. You've got homegrown players like Time Bank, Bank Zero, Discovery Bank, Better Finance.
Yeah.
They're really gaining traction.
They are. And the conditions are, almost perfect there. Extremely high mobile phone use meets a regulatory environment that's actually quite forward-thinking, quite open to innovation.
It's incredible how expectations have flipped. Banking used to mean queues, right?
Yeah.
Face-to-face, solid buildings.
Exactly. Institutional permanence.
Right.
It's all about digital ease.
Yeah.
Speed, transparency. People want banking to feel like, ordering food online or streaming a movie. Seamless. Intuitive.
Yeah, that move from paper and physical branches to everything on your phone,
Yeah.
it's fundamental. What's considered basic banking now is completely different.
Totally.
You expect instant services through an app, right? Digital sign-up, maybe using your fingerprint or Face ID.
Biometrics, yes.
And you need real-time updates, balance checks, freezing your card instantly if you lose it, getting an alert the second a transaction happens.
Uh-huh. And with mobile penetration over 90% in South Africa, many people just skipped the old way entirely. They leapfrogged straight to digital.
So how does trust work in this new world? If it's not the big building and the old name, what is it?
That's a great question. It shifts. Digital trust is built differently. It comes from transparency, like absolutely no hidden fees, really clear communication.
Okay.
And personalization. Neobanks use their agile tech, their data analytics, their AI.
Right.
To give you useful stuff.
Yes.
Spending breakdowns, tools to help you save, budgeting advice that actually fits your life. It feels like they're on your side.
I have to jump in there, though. When you talk about all that data and AI, isn't there a risk? People are wary about data privacy, and in South Africa, you have POPIA, the Protection of Personal Information Act.
Yeah.
How do they square that circle? Hyper-personalization versus privacy concerns.
That's absolutely critical. They manage it, or try to manage it, by making the data use obvious and beneficial to the customer. It's not surveillance for its own sake. It's presented as, we use this data to help you manage your money better.
So the value exchange has to be really clear.
Exactly. And they often build their brand on being transparent about data use, unlike maybe some older institutions with pages of confusing privacy policies. The deal is kind of, give us data, get real value and control back.
That makes sense. And you see the generational pull, too. Millennials, Gen Z, they just expect things to be instant, simple. Tech should work for them.
Right. And then COVID, well, that just accelerated everything, didn't it? Suddenly everyone, regardless of age, had to get comfortable with digital. So these expectations are pretty widespread now.
Okay, let's talk about how neobanks actually deliver. What's their main advantage?
Fundamentally, cost. Being online only slashes overheads. No branches, fewer staff. It's just vastly more efficient.
And those savings go to the customer.
Pretty much. Lower fees, sometimes no monthly fees at all. Maybe better interest rates on savings. That's the core appeal.
And this cost thing allows for really interesting models, especially for inclusion, like you see with Time Bank in South Africa.
Time Bank is a fantastic example, yes. No monthly fees is huge, but it's how they onboard people that's really clever.
It's not purely digital sign-up, is it? They use kiosks.
Exactly. Kiosks in supermarkets, places people already go and trust. So the account itself is digital, runs on the app, but that first step, it's physical, accessible.
Ah, so it tackles a couple of barriers at once. Trust, people might trust Pick n Pay or Boxer more than a new bank name initially. And maybe the data divide, you don't need a fancy smartphone or home internet just to get started.
Precisely. You walk up, use your biometrics, answer a few questions, and boom, you have a bank account in minutes. It makes that low-cost model genuinely transformative for people who were previously shut out.
Beyond cost, there's the user experience, the UX. You mentioned it needs to be intuitive.
Absolutely. They design the apps around what you need to do, check balance, pay someone, save not around the bank's internal processes. That simplicity makes it accessible, even if you're not super tech savvy.
It feels like it puts you more in control.
It does. Empowerment is a big part of it. Instant notifications, spending trackers broken down by category, seeing your balance update immediately, that gives you that real-time handle on your finances.
And the self-service aspect, like freezing your own card in the app instead of calling a helpline.
Huge. No waiting on hold, no business hours, just tap, done. That convenience is addictive.
So, without the physical branch, how do they build that credibility, that feeling of being legitimate?
Well, transparency again. Super clear fees, instant records of everything.
Uh-huh.
But also, some, like Bank Zero, actively build a community around feedback. They listen publicly, customers feel involved.
Interesting. So open communication helps.
Definitely. And combine that with top-notch security biometrics, real-time fraud alerts, it projects competence and trustworthiness, just in a digital way.
And we see different strategies, right? Time Bank focuses hard on local inclusion and SA, like their goal save, feature rewarding saving.
Very tailored to the local context.
Whereas a global player like Revolut is more about borderless banking, multiple currencies, slick analytics for international users.
Exactly. Both agile, both tech-driven, but solving slightly different problems based on their target market. And it's crucial to see neobanks not in isolation, but as part of this wider fintech revolution happening in South Africa. It's a whole ecosystem.
Right, like digital payments, mobile wallets, things like SnapScan, VodaPay are everywhere.
They are. But maybe the most game-changing part for inclusion is the rise of alternative credit.
Okay, explain that a bit more. What exactly is alternative credit?
Sure. It's about finding ways to assess creditworthiness for people or small businesses, SMEs, who don't have a long traditional credit history, or maybe any formal history at all.
So not relying on old bank records or collateral.
Exactly. Instead, fintechs look at other data points, things like your mobile phone top-up history, how you handle bill payments, maybe your transaction patterns on an e-commerce site. It's about using current behavior and cash flow data, not just past wealth.
To predict future reliability.
Precisely. It unlocks credit for potentially millions who are invisible to traditional lenders. Companies like Lula, Jumo Brand, they're really pushing this forward.
And that's massive for SMEs, for small businesses, isn't it? Because they're often the ones struggling to get loans from big banks due to, say, irregular income or not having assets to pledge.
Absolutely vital. Fintech is stepping into that gap. You've got platforms offering quick working capital loans, sometimes unsecured, based purely on recent business activity, like Lula, which used to be Lula Lend. They can process applications incredibly fast.
Wow.
And think about something like Yoko, those mobile card machines you see everywhere now.
Yeah, every small coffee shop seems to have one.
Well, by enabling those businesses to take card payments, Yoko's also helping them build a digital transaction history. And that history can then be used to apply for credit later. It creates the data trail that was missing.
That's clever. So it's credit access, but also tools for running the business.
Yes, often these platforms bundle in other helpful stuff. Automated bookkeeping, invoicing tools, ways to track cash flow. That's a whole support system.
But it can't all be smooth sailing. What are the challenges here? You mentioned POPIA before. Data protection must be a huge one.
It's a major tightrope walk. The entire model thrives on data, on personalization, on alternative scoring. But POPIAN imposes strict rules on collecting, using, and protecting personal information.
So they need the data, but have to be incredibly careful and transparent about how they use it.
Exactly. One big data breach could destroy trust overnight. And beyond security, there's the challenge of financial literacy. As you bring more people into the formal system quickly, you have to ensure they understand the products, the risks, the responsibilities. You can't just onboard people without support.
So how are the traditional banks reacting to all this disruption? Are they doomed?
Not doomed, no. But they've definitely been forced to wake up and adapt quickly. They're pouring money into digital modernization, upgrading their own apps, moving to the cloud.
We see that, right? Like Standard Bank's Shift app for international payments, or how FNB and APSA have really streamlined their digital offerings. They had to respond.
They absolutely had to. And what's emerging is this sort of hybrid model, sometimes called phygital banking.
Digital. Physical and digital.
Exactly. Let technology handle the everyday stuff, payments, transfers, balance checks, but transform the branches into advice centers for more complex needs, getting a mortgage, planning your estate, sophisticated investments. places where human interaction still adds real value.
And we're seeing collaboration too, not just competition, like Discovery Bank leveraging its insurance background within a digital bank framework.
That's a key trend. The future probably isn't just one model wins all. It's likely more about interdependence, partnerships, leveraging different strengths. Which brings us to the really crucial part for you, the professional listening. All this change fundamentally impacts how you work, how wealth is managed. Adaptability is key.
You need what? Digital fluency? Is
Oh,
that
yeah.
the term?
That's a good way to put it.
Mm.
You need to understand how your clients are using these new tools. Bank accounts, investment apps on their phones, maybe digital wallets, even crypto. These assets might not show up on a traditional statement.
So finding and valuing assets, especially for things like estate planning, gets more complex. You need to know where to look, what questions to ask.
Precisely. And client expectations for service have changed too. They're used to instant, transparent updates from their apps. They'll expect something similar from you. Secure digital communication, accessible reports. It's the new standard.
And ethical questions arise too, surely, especially around digital assets after someone passes away, access, security, transferring non-physical assets.
Huge challenges there. Who holds the digital keys? How do you securely store and pass on credentials? POPI compliance is critical throughout, but especially sensitive posthumously. It requires new protocols, new thinking.
But this complexity also creates opportunities.
Absolutely. This is where you can add immense value. If you understand the tech, the risks, like POPI, the different platforms,
Yeah.
you can guide clients effectively.
Yeah.
You help them integrate these new digital tools into their overall financial picture, their estate plans. You become that trusted digital advisor.
So wrapping this up, the future of finance looks, well, very different. It's digital, it's global, or at least less bound by borders. It's aiming for greater inclusion.
And it's all being driven by this relentless focus on the customer experience, on transparency, on empowerment.
Giving people more control.
Yes.
Yeah.
But here's a final thought to leave you with. Technology is transforming the tools we use in finance. It's making things faster, more data-rich, more connected.
Mm-hmm.
But it doesn't replace the core human elements: judgment, empathy, trust, integrity. The real challenge for all of us in this profession is how to harness all the power of digital without losing that essential personal connection.
That's a great point to end on. Okay, so the required knowledge for your professional development has been covered in our discussion today.
We hope it's been insightful.
Please do take a few minutes now to complete the short quiz associated with this analysis. It will help formalize your understanding and, of course, earn you that CPD certificate.